Hey, good morning, everyone. Marty Missouri here. It is the 22nd of February, 2026, with an update for you. I'm not going to be all that comprehensive this morning. I'm more or less going to pick on a few hot topics, a couple actually, and then we will talk a bit about some of the underlying market dynamics and take a quick look at a few charts. So the news of the weekend from Friday would be about tariffs. And so what I've done here is I've lined up a handful of Bloomberg articles from this morning just to highlight for you. The first one just kind of talks about where the administration sits now, or to what degree they've been at all hamstrung by the Supreme Court's landmark 6-3 decision on Friday that struck down many of the levels the president put in place last year. Hours later, he imposed a new 10% global levy instead and vowed to use other powers to maintain his signature tariff policies. And then yesterday morning, he changed his mind and said, let's make that 15%. But those come at legal constraints and complex procedural requirements. None will give him the freedom to deliver on threats to slap tariffs on European countries opposing his plans for Greenland or countries buying Iranian oil, for example. Quote, we know there's a tariff of 10% now for 150 days. What we don't know is what's going to happen after that. Mark Foreman, a former U.S. trade representative, and he now leads the Nonpartisan Council on Foreign Relations. It's now 15%, so he obviously said that on Friday. Response from trading partners, the EU may freeze U.S. trade deal approval on tariff chaos. The European Parliament trade chief will propose freezing the ratification process of the EU's trade deal with the U.S. until they receive details on U.S. trade policy. The proposal comes after the Supreme Court struck down President Trump's use of an emergency power law to impose reciprocal tariffs and Trump's subsequent announcement of a global tariff. The European Commission is seeking full clarity on the U.S.'s intentions. So, folks, essentially my message is, of course, there's still quite a bit here probably to play out. Apparently, bilateral trade deals will stand despite the tariff ruling. This is from the current U.S. Trade Representative, Jamieson Greer. He said that individual deals with trading partners, including China and the European Union and South Korea, remain in place despite the U.S. Supreme Court's ruling on President Donald Trump's tariff policies. Greer said that the administration will stand by these deals and expects its partners to do the same, and the alternative U.S. trade tools will give the U.S. leverage. The European Parliament, as I said, plans on freezing, for now, the ratification process, again, pending greater clarity. And then, of course, there's the Iran situation that is also front and center. President Trump said he's considering limited military strikes to pressure Iran into signing a new nuclear deal, but bombing the country may have the opposite effect. The Pentagon has orchestrated a massive deployment to the region, giving Trump the option to launch limited or extended operations against Iran. Iran experts argue that bombing the country in the middle of negotiations might derail a deal and could prompt a deadly cycle of retaliation. And I think the president and his team are probably very concerned about that. Top of the list of concerns would be that if we get something protracted in that region, it could have a protracted impact upwardly on the price of oil and therefore on the price of a gallon of gas in the United States. And the timing for that, with midterm elections looming, is not something that is appetizing. But here we are, and it sure looks like a strike may be imminent. These are very fluid situations we're dealing with here, so we can't really conclude much right now, but I'll keep you posted. Okay, so with regard to markets, I think I'll just go in order of the charts that I have pulled up for you and comment along the way. So this is what's called the S&P 500 Dispersion Index. The blue line is actually the S&P 500. The white line is the actual dispersion index. So what this measures is, as the name implies, the dispersion of returns among the members of the S&P 500 index. So the wider the range of returns, the higher the dispersion index is going to go. Now you notice I shaded areas where it's above 30 and shaded what the S&P 500 was doing at that time. I do not believe this is necessarily a bearish indicator. I think probably the best way to characterize a market with high dispersion is a stock picker's market, as opposed to just buying the broad market. Picking stocks becomes more important to the odds of success than just blindly buying the stock market, if you will. While dispersion is high, but you can see that in and of itself is pretty volatile. So now breadth is simply to what degree directionally the members of a given index are moving. So notice here, and this is year to date, the white line is the S&P 500, which is just barely in the positive, 0.95%. The purple line is the NASDAQ 100 index, which is actually negative on the year by almost 1%. The green line is the S&P 500 equal weight index. So all the same stocks, it's up 6.3% year to date. So all the same stocks as the white line, and it's up that much. Why? Because the white line is a cap-weighted index. Companies with the larger market capitalization, i.e. these ginormous tech stocks, which make up like 40% of the index, it's crazy, will dominate the returns. This one, each stock gets 1/500th. There's actually like 504 stocks, but let's just say 1/500th of the influence on the market. So lots of stocks are going up, while the big Mag 7, let's say, aren't, right? Some are down a bunch. Hence, we have this high dispersion, but more stocks in the average itself are actually going up. So when do you see this? When do you see high dispersion? When do you see breadth begin to separate like this? Perhaps high breadth. It's times when you get rotation in the market. So clearly, investors are rotating out of technology into other areas. And fortunately, clients, as you may have noticed, both last year and this year, we've been appropriately or sufficiently in these other areas to capture some very nice returns. When do these rotations happen? Well, they kind of happen at cycle turning points. They can be early cycle dynamics, these rotation events, as maybe investors rotate into very beaten up sectors, and they can be late cycle dynamics, as perhaps the emphasis is on rotating out of these super high performers, i.e. the very expensive stocks, and into the neglected areas. This we'd almost have to characterize right now as a late cycle dynamic. These dynamics also, by the way, do inspire quite a bit of tactical work on our part. In 7 weeks so far this year, we've already made 7 adjustments to the core allocation. And some of the things that we entered into this year and added to have had quite the rally, some uncomfortably in terms of the level. We have to ask ourselves how much of our thesis just got priced in a little less than 2 months. So that generally involves paring some positions back, taking some profits, and looking to areas that have been neglected or nearly abandoned this year, such as the software space, that suddenly there's a narrative that AI is going to pretty much destroy it across the board. At least at this point, that's not a narrative that we sympathize with, so we think there's opportunity there. And another example is consumer staples, which is not small for us, literally up 15% year to date. So this last week, we cut that a little bit, added to beaten up financials that we think are going to benefit from deregulation and perhaps from sustained interest rate differentials, assuming this economy is going to stay relatively positive, particularly with all this fiscal spending that's coming. And we added to our consumer discretionary exposure, anticipating the largest tax refunds consumers have ever seen in the U.S. soon to come. And then hedging our gold position, cutting metals back that have been ridiculously good. And then, hedging the left tail or hedging our overall market risk with our S&P 500 hedging strategy, meaning essentially buying a little insurance on what would be, above average declines in the markets, which can come. So we still think there's lots of risk in this market. But yes, we are finding opportunity, and we're going to continue to work very hard to unearth those opportunities going forward as well. That would be interesting to see kind of how the market reacted on Friday on the tariff news. It was a little bit muted. It was positive at the start, but I think the market knew that the administration had these other measures lined up. But when the announced measure was just a 10% global tariff, with that you actually end up with a notably lower overall average tariff on goods coming into the country. So that's when the market really began to take off on Friday. So what did well? Communication stocks actually did the best. They were up 2.65 on the day. Consumer discretionary, which I just mentioned, which fortunately we added to last week, was the second best performer, up 1.3. So communication stocks, which are still down 0.2% on the year, saw the biggest rally, and then discretionary stocks, which are still down 3%. So you saw the unloved sectors, or a couple of them, get a little love on Friday on the tariff news. Now, again, the president increase that by 50% from 10 to 15%. So we could see some give back come Monday morning. And then on the international front, Latin American stocks saw the largest move. They were up 1.73%. Emerging market index overall was up 1.63. The Eurozone was up 1.4. And Asia Pacific was up 1.3. So significantly better returns for non-U.S. equities than U.S. equities, which are also positive, save for small caps, which were down about 0.5% at the end of the day. So again, we'll see. There may be some give back on Monday, but we don't know that for sure just yet. Looking at gold for the last year, here we're sitting, consolidating after that big 17% two-day drop that we had here. This is a retracement of right at 50% of that decline. Okay, so in fact, it peaked above there. You can see resistance at this 50% retracement, which is pretty much the norm. You have the three key levels, 38.2, 50, and 61.8. That would be the next level of resistance, technically speaking, if gold wants to rally coming into next week. Looking at it this morning, priced in cryptocurrency, which trades 24/7, gold actually is up a little bit on the morning. Now, our momentum indicators, particularly the moving average convergence divergence, that's a very bearish divergence as we consolidate here. So this particular indicator suggests that there could be a little more corrective action, and maybe we come down and test this level here before gold is off to the races. Of course, it could go a lot lower. I've shown you those long-term charts. As for silver, it had that two-day 37% drop. Applying the Fibonacci retracement, you can see that it came back and found resistance at that key 38.2% retracement and just fell right back off of that and tested the lows again. We shall see. Silver had a whopping good day on Friday. I think it was up like 7% on Friday, and it found support at the 50-day moving average. So we'll see. In terms of momentum, pretty darn ugly, suggesting that not so much the relative strength index, but the MACD suggesting that there's still definitely another chance at retesting this low or lower. Almost nothing would surprise me right here, folks. That's in the metal space. It's a very volatile setup right here. As for the S&P 500, just stuck right in this range, still sitting at levels we were at back in late October. Closed just above the 50-day moving average. I suspect that if the market were to open right now, it would come down off of that just a little bit. Here's the all-time high. You can see we're a ways from there. Pretty tight trading range in here. As for the momentum indicators, they pretty much called it. Here you had new all-time high, but very long extended bearish divergence, suggesting that there's very limited upside right here. That still looks like the case. And with the NASDAQ still notably off of its all-time high, you had the same action in here, very bearish divergence. You can see where it was at the first all-time high, and just losing momentum here. And again, these aren't perfect. They're not a sell signal until you broke the trend line, which you did here. And then definitely we saw that pretty good decline there in the NASDAQ. And it's butting back up against this level right here, which was resistance that became support, and now it's resistance again. So again, folks, we shall see how this plays out. Next week's going to be very interesting. Some big earnings are coming out as well. Perusing earnings announcements so far, and they look pretty good, actually. I mean, there's mixed. I can point to concerning reports. I don't have the charts pulled up, but home builder sentiment took a leg down here last week. Consumer sentiment took a leg down as well. The PCE inflation data was a little hotter than expected. Savings rate came down. So here we are with the market, still right at virtually all-time highs, but we have sentiments, and particularly consumer sentiments, at least coming from these surveys, that doesn't inspire a lot of confidence. Again, there's a lot of oomph coming to this economy by way of tax refunds shortly, and by way of the One Big Beautiful Bill Act. We did see a pickup in industrial production in January. We did add our industrials exposure this year, add to it, I should say, materials, that sort of thing. So keep in mind the government is spending money at near record deficit levels. The kind of money you spend or the kind of deficits you run usually when we're in deep recessions. I would maintain that it's hard to have a deep recession when we're spending like there's already one and trying to get out of it. So we shall see. You get too many good things coming together all at once, and then we have an interest rate problem, an inflation problem, and that's kind of a 2022 problem when the market took a 30% dip during the year. So I'll leave it right there, folks. Hope you have a good rest of your weekend, and of course I'll be back next week. Take care. Bye-bye.